Hi, I'm Danny Hewson, Head of Financial Analysis at AJ Bell, and I'm joined by James Flintoff, Head of Investment Solutions at AJ Bell, and we're going to discuss changes being made to the AJ Bell funds as we head into 2025. Hi James, thanks for joining us. Can you summarise how you approach the changes to positioning?
Yeah, well, we're generally speaking quite slow moving at times. We try to avoid the noise in markets. We try to be long term in our approach at all times, and we try to be diversified at all times. So we try to be a bit of a steady ship in terms of how we position. And that means that we focus on a strategic asset allocation. We do allow ourselves to intervene in that allocation tactically at times if we feel that there's a risk building in markets or there might be an opportunity here or there.
So what are the major themes then surrounding some of the changes that you've made to the funds in January?
Yeah, there's two major themes there really in terms of the bond market positioning that we've got in the portfolios. We're thinking about inflation a lot and the risk to the upside and whether or not that causes any risk that interest rates might actually have to come up sooner rather than later, and what risk that poses to those bonds in the portfolio, whether or not we're taking too much interest rate risk there. We increased our interest rate risk in 2024, so we think we're winding that back a little bit this year. Then in equity markets, really, there's been some rotation in terms of how we're positioned, but the main theme there is the concentration risk. We're looking at that very closely in the US market in particular, so we've changed some of our positioning there to make sure that we avoid that at the margin, and we're going to monitor that through 2025 very closely.
And how has equity content changed within the funds?
Yeah, so as I said, there's been some rotation there, particularly towards Europe in places, towards the US as well. We've made sure that the portfolios aren't significantly out of line with what you'd see in the global equity market, but maintaining that diversification element to the funds as well. And as I said, we've changed how we position in the US, so we've made sure that we've removed some of that concentration risk in there, but at the same time conscious that we don't want to underperform the US equity market as well too much at any given point in time.
So what sort of market environment are you positioning for?
We try not to be too specific because we feel that being too specific leads to errors in terms of forecasting and positioning. There's lots of moving parts there. So we tend to be quite general. So really it centers around that inflation point, about making sure that we're not taking too much risk. We feel that the compensation for bond returns at the moment in terms of what the risk is relative to inflation, should that rear its head again in 2025, isn't really compensating us for that risk. So we've just dialed down the risk a little bit in bond markets, and that's really the major theme for this year in terms of our.
James, thanks so much for talking to us, and we look forward to catching up with you and the rest of the team over 2025 to discuss the fund's performance.
Thanks, Dave.